the Real Estate Players Podcast. Real talk, real players.
Welcome back, everyone. Today we have Sam Morris with Sunset Capital. Welcome, Sam.
Hey, thanks, Joe, man. Great to be on.
Good to have you and good to see you again.
Yeah.
What have you been getting into? Let us know first. What's just an update on what have you been doing lately in the real estate space?
Yeah. So as it sits today, today's February 3rd. So we just got back from NMHC last week, kind of a whirlwind of a tour there with that, us and 12,000 other people in the industry for multifamily. And then this weekend, we were out at the MFIN conference here in Houston. So it's been a busy past few weeks. Is probably the easiest way to say that. But just getting all the quarterlies done and getting ready for tax season, things of that nature. So.
What was your overall readout from the both conferences?
Yeah, so for NMHC, and for those that don't know what NMHC is, that's like the big mecca. I mean, that's the big multifamily conference of the year. That's where all the brokers and lenders and vendors, they all meet up, and we all go through kind of the synopsis of what we think the year is going to be. And I mean, they bring everybody in. So there's economists, there's all kinds of people that they bring in and what their pulse on what they feel the market's going to be. They talk a lot more from a national level, but we do break out into specific submarkets. And so what I will say is, the thought going into it was going to be people were going to be cautiously optimistic, and I would say that there's probably a little bit more realistic expectations going in for this year, but it's going to be very submarket specific. For where things are kind of going. And I would say for the most part, a lot of them were thinking that, there's still supply demand imbalance in a lot of areas. Some are taking it harder than others. And then some are actually, looking like they're going to be coming out a lot faster than others. And so it was a unique conference from the standpoint of, I would say there was probably a little bit more somber attitudes than there have been in years past. But because of that too, a lot of guys were very opportunistic, saying, hey, there's going to be some stuff churning through that really, if you're a buyer in 25, you might have the ability to find some things that are really advantageous for the next several years. So.
Now, for the listeners, you own both self-storage and apartments. I guess let everyone know just a little bit about your background and what you've got in your portfolio.
Yeah, so we're owners and asset managers in the multifamily and the self-storage space. We're lead GP on everything self-storage. We have a little over 2,000 units in there, and we're lead and co-GPs on the multifamily space, and we're about 1,500 units or so there. And I would say our portfolio from an AUM perspective is right around $250 million that we're involved in. But from a perspective of like by training and background, I'm an ex-corporate banker. And so my background more lends on, on the lending side and understanding that world really well. But what we do is, we're syndicators. So we pool money from all of our investors to go buy large commercial assets. And that's what we've done for the last 3 years now at Sunset Capital.
So for this show, we wanted to learn more about, focus more on self-storage. We've had a ton of guests for apartments on here, and I know myself, I do self-storage as well, but we love to focus on that. We haven't done a topic on self-storage, so tell us, what got you into self-storage? What are, in your opinion, what are the benefits?
Yeah, self-storage, and particularly from a management play, right? And just the ability to see how fast it's growing. It's been one of those things where there's a lower correlation of risk. Because of that, you pay higher cap rates, and they sell, from a dollar per square foot, typically cheaper than other asset classes, but you can typically make pretty good money in some cases, almost same kind of money on a dollar per square foot that you can in some multifamily assets. And so one of the things when your cost is a lot lower and the ability to run and manage it is a lot lower, but you can still make the same kind of money, it becomes very attractive from a return perspective in the self-storage world. And so, it's one of the things that we've absolutely endeared us. It's a higher cash flowing asset in a lot of cases, and a lot of our investors are, that appeals to them. So.
Yeah, no, I would agree 100%. I think what I find is storage, about more than half of the total return is going to come from the cash flow, whereas on apartments, it may be more lopsided you
On
may
the
get
back
more
end.
of it on the back end.
Yeah.
What do you guys have a fund or anything, or do you just do individual
We do individual
syndications?
deals. We will take down portfolio deals, but we do
Right.
individual syndications when we do them. And so it's been fun. I mean, we're dealing with one right now that's a little unique that we're having to deal with a potential issue with TxDOT. And so haven't had to deal with that before. So that's a first time for us where there's an eminent domain coming in on one of our properties. And uh, it could be from, hey, this is a little scary to, oh my gosh, the investors can make out like bandits in this deal. And so, and all the things in between and dealing with that. So
So I know you guys are based in Houston, but where do you own properties? Is it
for
just in
self-storage, we're
Texas?
all in Texas.
Okay.
Yeah. From Houston area all throughout East Texas, and even, we have an asset in Port Arthur, which is that Beaumont area. But mainly in East Texas is where we have the bulk of our assets, smaller towns there. We try to stay away from where a lot of the REITs are. They have a lot more marketing dollars to throw after things, and we try to compete in those areas where we can have some competitive advantage with our professional management.
Any other aspirations as far as other markets, or pretty much sticking with Texas?
No, I mean, I would say we've absolutely looked all over, and our property management platform has the ability to go coast to coast, the way it's set up. But really, just where we're finding value, and really for storage to work really well, you got to have movement, meaning people moving in and out and things like that. And in migration, in particular for Texas, has been healthy, and it's a little bit more stale in other areas of the country. And so we feel pretty confident staying in the state of Texas right now. But that doesn't mean that we won't look at opportunities at surrounding states or surrounding submarkets, for that very reason, right? We're looking for opportunities. So.
Yeah, I hear that a lot lately. Texas people just want Texas real estate.
Yeah, and it's good to have that we have assets here, right? From an exit standpoint, and but we look really all over. So.
Tell us about some of the value add strategies for self storage.
For self-storage, yeah, I would say some of our bigger value add strategies have been, really taking over a little bit more of the mom and pop type operations and bringing a professional management to it. And what it does is it does actually a few things because we can bring things to a site and add new income streams that weren't there before. And so growing the top line has actually been kind of key of focus, right? So you add things like we'll bring, say, U-Haul to a property, right? That wasn't there before. Now we have a new, business line that we can offer to the customer base that's there. Um, I would say one of the things that we've had great success with is our Storage Defender product. And really what that is, it's a device that we input into every one of the units, and it alerts the owner of that unit, the customer of that unit, if somebody ever enters the unit. And that peace of mind has actually been something that we found is just been tremendous for us and for our customer base. And there's a revenue stream associated with that, from a revenue share standpoint. And we couple that with the insurance that we require on all of our units as well. And so, those three items right there are items we've been bringing to a lot of our portfolios that weren't there before, and it's really found money. And what that does from a valuation standpoint has been tremendous, and particularly these last few years, where we're adding, services or products in this case to the customer, that allow them to have a better experience in storing.
No, I even, the U-Haul, it costs you nothing to start using that, and you make even a few $100 a month in commission. That's still that's still increasing your NOI. So
Absolutely. And we have sites that you wouldn't think it, and they're making, they're making over $1,000 a month with U-Haul, which is just a tremendous value with what that can do, right? I mean, what that brings to the property from a valuation standpoint, and it's really just a contract and making sure that you're getting enough vehicles in, um, for the site. So.
what's your opinion on automation? I know with self-storage, because it's easier to operate, you don't technically need a full-time person, but there's different approaches of, maybe we can do a hybrid, staff it part-time. I've looked into staffless, and it seems to be, we have better luck with it, at least a hybrid approach, having
Yeah,
somebody there at least part-time.
Yeah, and I would say, I mean, because we're a manned approach as well. I can tell you all the product that we've looked at that is staffless, or where they show, hey, we're manless property. When you go and tour those sites, there is a distinct difference between those that have people on them, right? And the shape of the property and things of that nature. We talking about other markets, we looked at some product. I believe it was last year or the year before. We went out and we actually had a product under LOI. We won the bid. It was two sites. They were in Memphis, Tennessee. So we do look over. But when we went out there and actually toured the site, uh, we pretty much went back to the broker and said, we're not going to move forward with the PSA. And matter of fact, you should probably call the owners and have them come tour their sites, because I mean, it was open season. I mean, they had people living on site. They had people, every vehicle was broken into that was parked there. Most of the units had been broken into, and it looked like a rave party had been thrown the night before. I mean, it was just unbelievable. And the amount of money that was going to be needed for CapEx just to get that back up to a usable space, and the amount of marketing dollars you would have to spend to obviously change the reputation of that site would have been tremendous. And so we quickly figured out why we were able to get it for the dollar amount that we did. And then when we went
Reason
out
for
and
that.
did our tour, it was, yeah, this is definitely not going to be something we're going to want to do. So and they were sites that were unmanned, and they looked like they were unmanned. So
What is typically your exit strategy?
yeah, our exit strategy, we typically are going to buy and hold to a certain level where we can exit and we try to back into a 2x of the money associated with our investors. But that being said, too, I mean, I tell everybody everything's for sale all the time. So, I mean, if we're able to achieve a higher IRR than what we were originally projecting, and it makes sense to exit early, we will absolutely exit early. And conversely too, like if it makes sense of, hey, we're a little behind on the business plan and we need to hold just a little bit longer so we can achieve this higher number, we would potentially hold longer, right? And so, it's really to achieve the highest amount of return in the shortest amount of time for our investor base is the business plan. And if that means we're only holding it for 12 months and a day, then we're only holding it for 12 months and a day.
So curious, obviously for all of us, there's been some challenges the last 2.5 years or so. What do you feel has been a struggle for self-storage in general?
Yeah, to me, it's been we're fighting for occupancy in a lot of submarkets. And it's really making sure that you don't overspend from a marketing standpoint to go out and get it. I mean, there are a lot of big companies that are out there that I mean, I call them toll booths to your own customer, and they want to charge you a lot of money when they bring you a customer. And it's making sure that you've got that dialed in really well from a marketing standpoint, in particular when you're competing against other REITs and larger groups that will just, occupancy is the only thing to them. They don't even really care about rate because they're just trying to hit a quarterly numbers for Wall Street. And so it's really making sure you play the ECRI game really closely, which the ECRI, it stands for existing customer rental increase, and making sure you're staying well within your market to be able to maintain the occupancy associated with what you need to be able to hit your goals.
So, in your opinion, I know some owners, they would rather maintain occupancy during the down season. And other owners, they would rather, hey, we're going to raise rates. And if we lose some people, it's going to make up for it. But the other philosophy is we might lower rates a little bit to keep people during November, December, January to maintain the occupancy. So what do you say?
I think it's very sub-market specific because we have some assets where we've done some raises even even late last year we were bumping raises and collections are net slightly higher even on lower occupancy. And then we have some other assets that I would say, look, just because of where we're at and the population that's there, I want to focus more on keeping the thing full because the cost of acquisition for a customer is pretty substantial, and it makes more sense for us to maintain the occupancy, i.e., have them make sure that they're staying in there month to month, versus going and trying to spend the amount of money to go chase somebody to come in who I'm hoping will pay at least what we have right now. And so it's very site specific, and it gets very granular when you go out and do that. And then we have another asset that's in lease up right now, and so I mean it's only about occupancy at that point. It's we're concessioning out. Hey, get whatever you can to come them all in because when you start at 0%, you got to get to a certain level before you're even at break even, and then another level to really start getting returns. And so it really depends on where you are from a submarket perspective and where you are in the market cycle of the property that you have. So.
Do you guys do any new development storage, or is it mostly you just buy existing?
We're typically buying existing, but
Yeah.
our last acquisition was a C of O deal. So we bought a deal that was
Okay.
brand new built. And we walked in right when they got their certificate of occupancy and we just started doing the lease up. And so we acquired that property about 7 months ago now. And so it's about a third of the way leased up, which is still tracking pretty well. And so we'll keep going, strong on that deal and giving concessions to be able to get it leased up.
When you guys say vertically integrated, is that just referring to your own property management in-house?
Correct. So we have property management and asset management. So Sunset Capital is our asset manager, and our partner in the deal is the property management group that's running it with us. So
Very good.
yeah.
Yeah, no, it sounds like you got a good thing going.
Yeah, no, it's
and so-
exciting. Our investors love it. We do great communication with them throughout the process too, so they're kept up to date. We'll do site tours for our sites too, and particularly for the investors that are involved, so they can actually touch and see the product that they've invested in, and so and learn how we do our process and what we do, how we do it, and why we do it. So
for anyone interested listening to this, if they want to know more about self-storage in general or investment opportunities, how is the best way to get a hold of you?
yeah, best way to get a hold of us is through our website. So if you go to sunset-capital.com, you can get a hold of us. You can join our platform, and you can start seeing the things that we have to offer. And in a minimum, you can get on our list. So we send out a monthly newsletter, so you can just be up to date with the things that we're tracking within the markets.
Very good. That's all we have time for today. Thank you, Sam.
Hey, Joe.
And love to have you back on, maybe talk about apartments next time.
Yeah, no, it's great. We love both assets. We're bullish on both, and so excited to see where each of them are going. So
Thanks, everyone.
thanks, Joe.